Seconds early. There we are, live episode 149. I looked at today, 149 of the Energy Week podcast, Energy Week live stream right here. Ryan Ray alongside the good doctor. Wait, you've changed your moniker, Dr. Energy.
Yeah, I did.
Dr. Energy, Ellen Wald. How you going?
Back. Yeah. I think I changed it when we had our other guest on because I thought it was like too long for the screen. I didn't want them to get, confused.
You are a woman of the people. There is no doubt about that. Ms. Wald, how are things in Florida? It's raining here in the great state of Texas.
It's freezing. Not actually literally freezing, but it's like in the 50s. Maybe 60. It's been cold for 3 days, and I'm wearing a turtleneck dress because I'm cold.
So we get...
But it's supposed to be 88 this weekend, so...
So in Texas, when it kind of starts, especially in the winter, it's where we live at, there's a lot of wind that makes it really cold. So right now the weather's not too bad, but that wind is still here, so it keeps it nice and crisp to put it mildly. So, hey, question before we get into the show: did you buy or sell your Aramco stock before the earnings?
Yeah. So interesting about that. So like Aramco trades on Tadawul, which is in Saudi Arabia, which is open on Sundays. So they were trading Sundays when they came out with their, and it moved like very, very, very tiny amount. I gotta say, news about Aramco's earnings do not drive Aramco's share price. I think that the Saudi stock market operates by other means.
Slightly different. Well,
slightly different things holding the strings, maybe.
Well, it's interesting because look at this kind of how that's going to work out, because you're right, it doesn't have the same feel as it does here in the U.S. So okay, Miss Wald, I apologize, I didn't have the email open for some reason. There we go. Okay, so a couple of stories to get to, and we have one Dr. Dean Foreman coming on in about 30 minutes. Let's see here. One thing I don't see in the show for today, I probably should send it over to you. Did you see the new benchmark that they're releasing in is it Dubai for crude, for oil?
Yeah. I did hear about that. Is that the Merben one, or is that?
I can't pronounce it, but that sounds right. Yeah.
Yeah.
Any thoughts on that? Any that change anything? Any thoughts or takeaways? Have you looked into it much?
I honestly haven't. I think that still most people will be interested in WTI and Brent, but there's also like Western Canadian Select, which we don't look at that much, but is an interesting indicator because it gives a really good indication and of what the going rate for heavy crude that's really hard to get out of places is. So I think it's more information is better and just adds to our understanding of the market, but I don't think that I think it has a real uphill climb to become something like WTI or Brent, where that's what everyone's looking at.
Okay. But the Saudis, they're selling on their own price, right?
Yeah, so Aramco issues, everyone sells at their own like price based on exactly what the, what type of oil it is. So Aramco usually issues OSPs, official selling prices, at the beginning of the month for the following month for different areas that it's selling to. So it'll issue like a certain price for a certain type of oil that's going to that's being offered to Asia or being offered to the US or Europe. And it will also do it by grade. So like Arab Light is a grade that they offer. And that was actually one of the interesting things. I don't remember if we talked about this when we had the authors of The World for Sale on, but they had a really interesting, there's a really interesting anecdote in their book about how these how these commodities traders, they would basically substitute different grades of oil when they didn't have or thought it was like too expensive to supply the grade that was asked. So they would be like, oh, you asked for this grade, but we're actually going to give you this other grade that's much cheaper for us, and like kind of lie about what it was and pocket the money. And then, and they try to like mix it to get the exact right like API, and they never quite got it, which is kind of interesting.
I just love the fact that, feedback. Are you hearing that?
No, I'm not getting any feedback, but you're kind of choppy.
Let's see here.
Oh, you're better.
Yeah. There. I think it's gone now. Okay, we're good. There we go. Yeah, the choppiness sometimes comes through on the stream, but the recording somehow takes it out. I don't know. I just love the story that they're like, "Hey, we flew in. We're selling to the rebels." You know, okay. Like, it kind of puts the raw feel. Like when you read these books on geopolitics, and I'm doing one on China right now. I'm reading, and it's like, well, we thought this was going on, and so we did that, and then you got these commodity traders who are like, yeah, we're selling to everyone, and so it just goes to show that when you follow these stories of these geopolitical conflicts and kind of how they're unwinding, like there's so many perspectives that you could pull back the different layers from, and there's so much that you miss. There's so much nuance there. So, anyways, okay. Let's get to our first story. Biden's backdoor climate plan. This is from the editorial board at the Wall Street Journal. I know it's serious. Emails reveal the strategy behind the new regulation to come. Biden wants Congress to pass climate change legislation, but that faces political obstacles. No worries. State Democrat attorneys generals are conspiring with green groups on a regulatory plan B. Bum bum bum.
that last sentence was a bit over the top, but it is the editorial page.
Yeah, it is the editorial page.
Yeah, I read this last week and I was like, wow, this is interesting. So apparently, there was this ruling in Massachusetts versus EPA in 2007 that kind of defines what the term pollutant means. And they say that it does cover, like it includes greenhouse gases. So, but they never actually said like how the EPA is supposed to regulate CO2. So CO2 is a greenhouse gas, which you can technically say is a pollutant. So when you breathe out, you are breathing out a pollutant, according to the federal regulations. Anyway, so then that set the ground for this other regulatory things where the EPA then declared that greenhouse gases are a threat to public health and welfare and all of this. Now they list it as a criteria pollutant, all these like regulatory things. Okay. Other criteria pollutants are like carbon monoxide.
Oh, yeah, obviously.
Yeah. Right. Ozone, particulate matter, things like that. So basically the question is, can the EPA regulate CO2 under its regulatory authority? And the question is like, well, it might be able to. You can argue based on a lot of these rulings that it can. It's technically like it could be, except that it's not considered. CO2 doesn't cause like asthma or diseases, so they might not be able to. There's a question over whether you could do that, and a lot of EPA administrators said like we can't go that far. Like we're not going to try to claim that we can regulate CO2 under this authority. But now there's this new guy who thinks
Not
he
the old
can
guy.
get away with it. Yeah, there's a new guy in, and so this article is basically explaining how they can use this like backdoor way by using this regulatory issue to force states to reduce CO2 emissions by tightening the ozone standards. So they can say, we're going to tighten the ozone standards, and this could include CO2, so we're going to force you to regulate CO2. So if the federal government can force states to regulate CO2, basically that means that states might have to outlaw natural gas-powered appliances, gas stations, internal combustion engines, just to meet these strict guidelines, which would totally change our way of life.
So, yeah.
So this is like, I'm not saying that this would happen. It would obviously face huge, massive legal battles, all that kind of thing. But it's something that is definitely being talked about, and I think it's something that we should be aware of.
I mean, I don't know if I've talked on this show or not. I know I've brought up other places, maybe I have, but the states, in my opinion, have to take back regulatory oversight from the federal government at this point. This isn't a Trump issue. This isn't a Biden issue. This is just a common sense issue that we allow the federal government to have way too much influence. You talk about getting new refineries built. You talk about getting things done. You got to go through the federal government to get a FERC permit. And those positions we've talked about in this podcast, they come and go, right? A new administration, you get new planning. So the states, when they want to, if you look at Colorado, you look at Washington, you look at Oregon, they've legalized drugs, California, to varying degrees, and the federal government has left them alone. Now, that doesn't mean they would leave you alone for EPA issues. I'm not saying that, but I think that the states at some level will have to decide how far they're going to let this go. And you're seeing this with the tech stuff, right? So the states are starting to sue big tech over what they can do inside their state or not. So I really don't think it's a far leap to start saying, okay, let's listen. First off, there's a question in my mind: is the EPA constitutional or not? We'll set that aside. But let's just say that it is. Does that give it the right to mandate everything that's going on here? And I think the states at some point, especially like Texas, where I'm at, you're going to have to sit back and say, okay, do we want the federal government to ruin a large portion of our industry, or to benefit the elite? We talk about income inequality and all these things, and all these regulations. They push the wealth to one side of the equation because those are the ones who can manage these kind of risks. Whereas Walled and Ray Drilling would go, we can't deal with all that. We're going to go out of business. And so, I think the states will have to eventually take up this battle, regardless of what Biden does or how far it goes. But I haven't seen a lot of talk about that, but I do think that is something that at some point will have to be under serious consideration.
I mean, imagine if things become so bifurcated where some states like, yeah, we're regulating this stuff, and they're basically like outlawing like propane grills or whatever and like lawnmowers, okay? Mm-hmm. and then other states are like, yeah, we're fighting this in court, and they're like, please come to our state. You can drive your internal combustion car and ride your lawnmower or push your lawnmower and use a leaf blower or whatever. It's like, I mean, imagine the bifurcation. It's like a dystopian federalist situation where like Florida and Texas and like the South are like, here, you can live as you used to, and other states are like, no, you have to have, I don't know, everyone has to buy an EV.
So let me ask you this. You know the European workings better than I do. Who has more authority, the federal government of the United States or the EU over the European states?
It's funny because I was just looking at something online where they were like, Brussels is like controlled by the Germans. They're trying to like greenwash the Nord Stream.
Well, it's just funny because we Americans are like, oh, look at them European socialists over there. My God, we would never go for that. We're like, yeah, we need more regulations from the federal level. Yeah.
Hey, look, the thing is that it doesn't have to be this way. It's just that like a lot of governors let it be this way.
Well, we saw that during the lockdowns, right?
Exactly.
And that's the point with energy and energy professionals. They are depending on where you're at, we're really good at messaging or you're really bad at messaging. But we have to realize that I'm not saying that you don't need a federal government. I'm not arguing that at all. But I am saying that when the states want to push back on certain issues, they have shown that if they want to, they can. Now, will the federal government allow you to push back on something like this? I have no idea. It would need a state like Texas to actually take the mantle and do it. And I'm not for just, hey, let's just ruin the earth because we're being stupid either. But when you look at what's happening in the energy business, it is something to be concerned with. There's something else in this piece I was going to ask you about, but I do not. CO2, carbon capture. I don't remember. You had said something that had sparked my curiosity.
You know what I want to talk about?
Yes.
Why did they decide to stop writing CO2 with a subscript? I understand, like on regular computer, like if you're like writing it on Twitter or whatever, you can't get the fancy subscript. But like, this is a newspaper. Come on. Isn't the like Chemistry Federation complaining here? Sorry. Stupid quibble.
Oh, I don't know. That's a fair question to ask, though. The editorial board is welcome to come on and defend their lack of using the subscript. So we will have.
I bet they would punt to the copy editors, honestly, the typesetters. Oh, we lost that one.
Okay, another one from the Journal: Oil investors hunt for cash gushers. Okay, let me just say this. I said this on the Textual Gas podcast this morning. Can we officially say that the Saudis got it right?
I mean, yeah, that they're more focused on satisfying their investors than they are on pumping oil. I think so. I just don't see what's so bad about like 10.9 to 11 million barrels a day of production. Like, I don't think that there's. Why do we have to be at 13?
Well, I'm just saying, when the I'm just talking about just from the lack of adding barrels to the market because, I was surprised that they kept them on in January. I was really surprised they kept them on last month. And I just kind of made a simple analogy, the hamburger analogy. How many hamburgers you think you're going to produce? How many hamburgers you think you're going to need? And they thought they needed a million less hamburgers. So that's what they did. Now, I know Big Oren will be on his refinery kick and all this other stuff, and he's probably right. But at the end of the day, they kept the barrels off the market. The price hasn't. Huh?
Now I want a hamburger.
Yeah, me too. But at the end of the day, the price has not skyrocketed. It's stayed at a good margin for Aramco's the world, right? They're happy with the $60 oil. It's not been high enough for the Texas oil and gas folks to come out and just drill the price down. I mean,
why not? This is what I want to know. Why is it not high enough? Is it just not high enough because they're like, we don't care. We took out all the competition is the floor of Texas is now littered with our competition, or so they're like, why bother?
I don't know. I mean, I have a thesis that hasn't been proven wrong, so I'm just gonna keep riding the horse until it's proven wrong. Which is, I think that the banks are just reluctant to give a lot of money to the frackers right now because the Saudis can change their mind literally month by month. And so that's just kind of my working thesis. And I'm not saying it's right, but it seems to kind of fit with the puzzle pieces that we have. Maybe the bankers have been burned, but the energy stocks have done really good. Oxy stock, I don't know if you looked at this or not. It was like $9 a year ago today. It's 27, 28 right now. If you look at these energy stocks, especially oil and gas companies, they've rebounded quite substantially. And so maybe it's something else, but I think that the pressure of knowing that the Saudis could change their mind is out there. Maybe it's real. And also, is the price? I mean, if you look at some of the people talking about the physical stuff, it feels like the price really is even a little bit higher than it should be.
Yeah, I mean, I think that the correction last week was probably, important for the market. As I wrote a week early in my investing.com piece, I basically said, here's why I don't think here are some reasons why oil might not keep going up.
Mm-hmm. Mm-hmm.
And I was roundly criticized. How dare you? Oil keeps going up. And then next week it went down. I was a little bit ahead of the game, I think. It's kind of
when you have a record build in storage and price still goes up, it's kind of okay. It's like, yes, I was wrong, but who could have ever predicted that the price we'd have a record storage increase and the price would go up in the same day?
Yeah.
Okay. But anyways, so folks are hunting for cash gushers.
Cash gushers.
Where might they find a cash gusher at these days? Tesla?
Well,
we talked about Tesla
government's printing a whole lot of it.
Can we talk about Tesla before Foreman comes on? I want to talk about Tesla, but go ahead.
Oh, Tesla, yeah. Bitcoin. Yeah, it's I mean, they say that free cash flow expectations seem to be recovering at a faster pace than oil prices, which is helped by cuts to CapEx. Mm-hmm. Exxon expects to up to $19 billion in CapEx this year, which is a lot lower from its 10-year average of $29.4 billion. But that will make free cash flow rebound. So they're all playing games, I think, with their financials to make them look as best they can, even though they're not good. I mean, Exxon lost $22 billion, I think, this year.
Yeah.
Compared to Chevron, which only lost 5.5. But they did financial hanky panky. Everyone does. Okay. So analysts expect EOG Resources free cash flow this year to be almost double what it was in 2018. Okay, but then what are you going to do with your free cash flow? Drill more wells? Pay bigger dividend? Pay executive salaries?
I think the dividend's key. I think if you're an oil and gas company and you've been paying a dividend and you lowered it or whatever, I think you have to get back to paying your dividend right now because investors are looking for a reason to leave. And if you remove the dividend, you're not Tesla. You're not going to go from Okay, you went from 9 to 30 for Oxy. They've rebounded, but they're not going from 30 to 700, right? So they may go from 30 to 40. Something crazy happens, but there's kind of a range. This is not tech stocks where you're just going to go blow it out and go crazy. So paying the dividend quarterly or monthly or yearly or biannually, whatever they're going to pay it, paying that, not lowering it, and actually maybe increasing it is something that you're going to have to do, especially when the prices are kind of low right now. I'm low in materials. So I think that's important. I think that's something that can't be overlooked. So two other quick stories I think are really important. I'm glad you put them in here. Saudi Aramco to prioritize China for the next 50 years. No surprise there. And also China's 5-year plan focused on energy security. So
yes, my question was, Aramco loves China, is super into China, but is China just as into Aramco?
Why wouldn't
their energy security plan?
Well, I mean, I think China's into whoever will sell them stuff, right?
China's into everyone. The 5-year plan recommits the government in very broad terms to formulate a plan for peaking carbon emissions before 2030 and anchor efforts to achieve carbon neutrality by 2060. That sounds like kind of some like roundabout speak.
Well, did you see how much wind energy they put in last year?
How much wind energy did they put in last year?
I'll pull it up. Just take a guess.
Like 10 gigawatts?
No.
100?
No.
0.
52 gigawatts.
52 gigawatts of wind energy. Yeah.
That's what they say.
And how many coal power plants did they build?
I don't know. So here's my thing. So we have the US, and if you're a listener who follows the digital yuan, I would love to do a very short ebook on the digital yuan. It's fascinating to me. But okay, just hear me out. Let me put my tinfoil hat on here for a second. Aramco needs to sell oil. China is not into the games that the U.S. Okay, China has its own set of games, but those games kind of align with what the Saudis. The Saudis. If you tell the Saudis don't criticize our government, then China's which China would say, the Saudis like, cool, whatever. We're not going to criticize anybody. Like, what do we care? They're happy. What do they care? China's doing deals with all these countries in the Middle East, Iran, and they're doing deals with Venezuela. They've been pushing their digital to yuan. Aramco needs a reliable partner who's going to have growth. Are the U.S. dollars getting printed? Are we going to see the end of the petrodollar? Like, is it coming? Is it coming? I know people have predicted this since like it became the reserve currency in 1944, but
yeah. So interestingly, I think that would, excuse my language, that would well, I won't use that word. I was thinking that would really mess with Saudi Arabia because their currency, the rial, is pegged to the dollar. And so if they unpeg it from the dollar, like they're going to have like a lot of inflation and other issues. And the reason they peg it to the dollar is because oil is traded in dollars. So
now
there's definitely a lot more like complex machinations that would have to go on in order to successfully like unpeg the dollar from being the petrodollar to the petro yuan or the petro ruble or whatever, the petro Bitcoin, who knows? But I mean, the Saudis are always like, yeah, we're going to unpeg from the dollar, we're going to get you, and then they never do because it would cause a lot of inflation. So we'll see.
Yeah, I don't think it's happening today. I think the U.S. will do everything in its power to keep itself as a reserve currency. I think a lot of its allies will do everything in its power to keep the dollar as a reserve currency. But China's digital yuan, what they're doing with their currency, they are going to be, in the next, their per capita usage of oil is only going to go up. They're going to be a big time buyer of oil for a long time to come. At some point, I think China's going to say, I don't know if this is this year or 10 years from now, but they're going to say, listen, we're tired of having to deal with all this bull crap from the U.S. and the reserve currency. Listen, we just deal with us directly. We don't need that anymore. And so, and if they are a big enough buyer, they can then have that kind of sway. They're not today, but if they keep trending, and if the thesis is right that China has really kept the oil markets propped up, think about that for a second.
Yeah.
If China is the reason, is a big driver of why prices are 60 right now because of all their excess buying, would it be crazy for them to come back and say, listen, guys, we're the one buying all the oil when prices are cheap, screw the dollar, come to the digital yuan or whatever else. So I don't know. I'm again, I don't want to like, it's going to fall apart tomorrow, but
yeah,
China's in the China game, and so
I think in a world where like the American economy collapses because we like print too much money or something and cause too much inflation. I mean, apparently the new Biden spending plan is like $3 trillion.
I saw that.
We've already spent $4.8 trillion. What's another three? 7.3. Could you? And that's without like keeping the current tax cuts that they have in. So if you add in those, that's like another like many billions of dollars.
I'm just glad that we're taxing people who make over 400,000 more because we're really going to pay off the debt.
Yeah,
that's what's going to do it. That's what's going to do it. Those $400,000 earners are really going to pay off these trillions of dollars and that we're printing out of thin air. I wrote this in the War Room newsletter and I put it on Twitter, and I saw Tucker Carlson stole my idea the other night. Why are we charging people taxes?
Okay, they do that, don't they? News people. They steal things that they see on the internet. I know. Ugh, I hate it.
I don't know why. I mean, serious question. Why are you going to pay taxes? We just print it. Yeah. I don't know who wrote MMT, but please rewrite it, expanded chapter, a little epilogue. We don't have to pay taxes. Just print the tax.
Oh, yeah, the modern monetary theory thing.
Just a little appendix A. We only pay taxes.
No taxes, exactly. We don't have to pay taxes, and the money comes. And the government just gives us stuff.
Oof. That's how it works today. So why we pay taxes? I don't know. So okay. We got on Dr. Foreman. There he is. Let's see here. Put you on the big screen, Dr. Foreman. There you are.
Hey.
How you doing, sir?
Good to see you. Good to see you both. How are you?
Good to see you. Good to see you. Let me pull up your note here while I'm getting going on. Dr. Dean Foreman with the chief economist for the API comes on usually monthly. Well, this is monthly, but usually a week earlier than this. We usually have the advanced copy. This week we're a week behind, and so we're kind of. It's not the same, Dr. Foreman. To be honest with you, it's not the same. We like to have that inside information.
It makes us feel super special.
So one time a month we feel special.
Well, we 9 times out of 10 do it that way. I think we'll resume doing it that way. Yeah, yep. And this time you got the bonus. You got the quarterly in addition to the monthly.
Yeah.
We'll
favorite thing, right?
We'll let you slide. So let me just, we are at a weird time right now because we talk about year over year. Well, this time last year, the world was freaking falling apart. Okay. just from your standpoint, generally speaking, year over year, are you pleased with the progress that you've seen from the oil and gas industry and how the economy's rebounded, or kind of where? I know you guys have your charts tracking this stuff. How would you? I know you're not making forward predictions, but just historically, how do you think the economy's rebounded over this past year?
I think it's actually pretty remarkable, and there's some things that stick out, and I'm sure we'll go through some of this. But one is the extent to which the economy's just come back, and the fact that oil demand, along with it, to be just both in January and February to be within 1.2% in January of a year ago, and now 2.5% for February, given all the February disruptions on top of it regionally, is just phenomenal. And the other is not such a positive story, right? It's that despite the fact that we've now had a good month or so of some pretty solid oil prices, recovery and natural gas prices, you look at those Baker Hughes rig counts, and they really haven't come up very much. There's some, but the oil rigs actually went down by 1 this last week, despite the fact that we have $65 WTI. So this also says that despite it's going to take more for the industry to come back, despite the fact that we've got prices back in an area where it should be economic to drill. If you've, as a company, just gone through yet another round of layoffs less than a month ago, you can't change on a dime and start suddenly redeploying capital. So that's really, as someone that loves and has been part of this industry for decades now, it's hard to see because you just can't see the vibrancy, that same responsiveness. There's a wedge, and it's going to take, I think, prices sustaining and being stable at higher levels before we start to see the ability to redeploy capital come back to the industry.
Okay, you have on slide 5, I believe, of the quarterly report, global real GDP outlook, and you say, led by emerging markets, third-party consensus estimates are for global real GDP growth for 4.7% year over year in 2021, and 4% year over year in 2022. I've talked for some time about this will be a trend to follow as these emerging markets open back up. 4.7%. That's kind of an interesting number because you're counting some really bad economies in there and some economies that are set to boom. How does that number hit you? Because when you hear about when you kind of lump these all together, you're getting like Madagascar and you're getting South Africa and kind of the same bunch there, and the responsiveness is not going to be the same. But if you look at I think the African Energy Council, or if I can't remember who it was, they released their annual report and they're talking about all the money that they're going to need to be invested into their economy to kind of get it going. I've been waiting for that narrative to kind of take hold. Do you think that's where we're at now? We're about to start seeing these World Bank dollars being poured into these emerging markets to kind of stimulate these economies?
Well, we need the multilateral institutions to continue to support hydrocarbon development globally. And right now, outside of liquefied natural gas, that's become one of the hot button issues. I think for the economic outlook slide that you've highlighted, there are a couple of things that are remarkable. Context is everything here, right? So 4.7% growth this year, broadly expected. And this is a combination of the Bloomberg consensus, which surveys economic growth, real GDP growth estimates for as many as, depends on the country, but it can be 40 or more forecasters, right? And the IMF. So you don't have the Bloomberg consensus covering every small emerging nation around the world. So between the IMF and that, you cover the world. But the challenge is when you get real growth estimates, growth off of what? So every economy, which measures itself in its local currency, if you're going to look at a global picture, you have to convert it back to dollars in some way. And there are a couple of ways of doing that. But the way that we're showing it here, and something that makes this more remarkable, is the fact that we use actual exchange rates. So the term is market exchange rate basis. They're market exchange rates as they existed in 2010. So in year 2010, the real and the nominal are the same, but you're using that 2010 exchange rate to convert every other year into a consistent basis of US dollars. What's important about that is that the other way of doing this is called purchasing power parity, where you adjust for the fact that a Big Mac in China, a dollar goes a lot further in China than it goes in the US even today. When you do that and use the other metric, you put 2 or 3 times more weight on the emerging markets. When you use actual exchange rates, it's kind of straight up. So between us and Europe, minimal adjustments, if any. The emerging markets don't get nearly as much weight placed on them, yet you still have 4.7% growth this year. And over the last 20 years, including 2020 with the downturn, it averaged 2.5%. If you exclude 2020, it averaged 2.8%. So to get to 4.7% and then 4% the following year, historically 4+% growth has never been sustained. I mean, this is remarkable. So this is, you'd have to go back to the early 1970s to find 2 years where you've grown as strongly, first off. And then when we translate this into oil markets, we've never seen more growth, at least going back to 1950 and the data that we've got, of 2 years of anticipated oil market growth at record amounts. So if this plays out, you've got both an economic rebound across every region, resoundingly strong growth in China and emerging Asia, oil demand globally coming back with this to record quantums. And on top of that, then as you alluded to, Ryan, that you've just got a challenge of coming up with enough supply quickly if you're not drilling and investing at a pace starting right now. And a third point, I guess, for context is let's take the U.S. Energy Information Administration and its outlook. A month ago, when we looked at it, they had the U.S. basically up maybe 200,000 barrels per day this year, and up about a little more than 1 million barrels per day in 2022. So call it 1.3 million barrels per day over a couple of years. Fast forward to their March revision and their short-term energy outlook, and this is not to ding their credibility. I think it's an artifact of the way they model it, and it's great modeling, and it's really arduous work to do, and there are uncertainties that go into it. But suddenly they go up to saying this year the United States will be up by 1.7 million barrels per day instead of like 0.2. And on top of that, another 1.3 million barrels per day in 2022. So you get to 3 million barrels per day US increase out next year in EIA's current view, which is just a tectonic change from where they were a month ago. To believe that you can get 1.7 million barrels per day of increased output by the end of this year What do you have to believe? And that's where I go back to Baker Hughes and I say, well, what's happening on the rig count? It went down week on week by one. So look, there's got to be a lot more money flowing into investment for CapEx across the entire sector. You're going to have a lot more drilling activity picking up. You can't stay at 400 rigs total and expect that this is going to you know, even sustain the current levels despite the productivity gains that we've had. So we really need to, you know, peel back the onion on the artifacts of the potential modeling that we're looking at and start to say, you know, where do you need real dollars flowing in to affect these outcomes? And it's not just a US issue. I was on a panel a little over a month ago with one of the West African oil ministers who was saying that they're not investing. So it's not a choice. It's out of necessity and having gone through the downturn that they have. So now let's come back to the report I think you were referencing, Ryan, was the African Energy Chamber. I'm actually on their advisory board and contribute to a lot of this discussion. It's critically important that these economies have the ability to develop their own domestic resources, to alleviate energy poverty, to participate and attract capital. I mean, that's the opportunity that everybody else in the world has had over time. And here we go. You know, if the multilaterals don't support the continued development of this, it's going to be really hard to satisfy that mission of alleviating energy poverty and having growth, and frankly, the ability to fuel the economy going forward.
So is this the right time for like green energy or renewables or just EVs to kind of take off because we didn't prepare for it, there's no hope? Or are some of the, you know, is this a case of like the Middle East is going to be back in as you know, the kind of drivers of prices and supplies, or is it a case of, you know, they know where the oil is, they know where to drill the wells, they just need to go out there and advocate for the capital and they can hire the people and do it quickly? I mean, it seems like there are the kind of three scenarios here.
And I don't think those scenarios are mutually exclusive. And you've hit on some good corners on it. And frankly, all of them are important. So there is an economically based and a politically based and frankly a climate imperative based need to have renewables, you know, step up as part of the energy mix. There's no question about it. But because when we see that the total energy demand and oil and gas along with it are continuing to grow along with the economy that's coming back, it is an all the above strategy. In this environment, something that has shifted was, you know, maybe this was OPEC's agenda back in 2015, but the market did it for them. And now the damage that's happened to the publicly listed companies or the private sector in having the capital to be able to redeploy right now, OPEC does have more market power than they did. And the market is seeing that, and the energy policies that are bubbling up from the state level in the U.S. and coming down from the top federally in the U.S., you know, now may at least frictionally slow the ability of the U.S. to redeploy that capital and grow its production again. So, you know, coming back to, you know, all of those prongs and scenarios, I think are important here.
Can we talk a little bit about natural gas? Because I thought that the slide about the natural gas market recovery you said in Asia Pacific and Europe has really brought record trade for U.S. LNG exports. And right now there's a lot of talk about the Nord Stream 2 pipeline, which looks like it's probably going to come online, I guess, pretty soon, regardless of all the sanctions. Is this going to kind of throw a wrench in U.S. LNG exports, or are U.S. LNG exports, you know, are they competitive regardless because like Europe just really wants that gas?
Well, you know, it's interesting because Russian gas coming in, by and large, Europe hasn't been short Russian gas. It's been a question of price competition and, you know, where they set relative to LNG coming in or pipeline gas coming from North Africa. That's your gas on gas competition throughout continental Europe. Nord Stream will only increase that. So you'd see, you know, more competitive supply and frankly, a market that because you have domestic production continuing to drop off in continental Europe, they're going to need more to supply the gas that they need. And there may be more renewables and other things that come into the mix, but at least for now, that's, I think, a healthy situation as it plays out, give or take the sanctions and the political sensitivity to Nord Stream 2. Now, where we go globally, I think you hit it right, that Asia it shows up in the economic numbers. It shows up in not just oil demand, but also gas demand and exports. That's continued to be the healthy long-term market for LNG exports. We'll see how it plays out, but this union between Atlantic and Pacific Basin gas markets, an increasing tie in the regional pricing, and the reassertion, if you will, of historically you had North American prices, European prices being basically twice those in North America and Asian ones being 3. In January, we saw that multiple of 2 and 3 open back up. And it's just going to continue to increase the price effectiveness. Europe will probably get a better deal out of this. But right now, I think the U.S. continues to be cost effective in part. This last year, pushing into Europe really just on a price competitiveness basis as it's leveling out, and you're seeing more of these agreements put in place with new terminals starting up. You'd expect that will continue to move around, and that pipeline coming from Russia into Europe will just be one of the many puzzle pieces that plays out.
So, slide 12, I believe, EIA projects U.S. liquid fuel consumption could return to 2019 levels by the second half of 2021. You have a handful of categories here that break that down, and I'll let you kind of emphasize the importance of them. One of the things we've wondered about is when we talked about this with the flights, and you had a few months, some of these flights are gone. So when we look at these numbers getting back to second half 2021, where right now are we seeing that there's just cars are just driving longer distances, maybe less cars driving, but longer drives, longer flights, or are we getting it back basically on aggregate where it's the same amount of people drive the same amount of miles? It's just we thought things were going to shift, they didn't really shift. Do we have the data to even know that yet? Because back to 2020, second half of this year is encouraging, obviously, but I'm just curious, do we know how we're getting back there?
So the path has changed. It's a great question. Yeah, no doubt about it. On the driving side, when we looked in March compared to March 2020, it's interesting. The Apple Mobility Index was actually positive year on year, but the vehicle miles traveled estimates of that were actually down year on year. And it does depend on where you look and how you weight it. There is no doubt on a nationwide basis in terms of fuels that it is down year on year, at least for gasoline. Now, that said, diesel fuel with more trucking and freight shipping is up year on year and has been. And we see this showing up especially in trucking load data. So whether it's van rates, refrigerated truck rates, any long haul or spot truckload is definitely the rates and the numbers of those loads being offered are up stratospherically year on year right now. So truck vehicle miles traveled along with total freight are up. Flights down, and I think about your question a lot, Ryan, because you ask about jet fuel. You both do in each month, and we thought about that and put in this dichotomy between the flights year on year versus the passenger traffic year on year, and where passenger traffic is still roughly cut in half, the number of flights is down between 10 and 20% year on year, depending upon when you look. So this also says that cargo flights, that is an important part of this mix, but it's still, from a jet fuel perspective, down substantially year on year. And then the thing that's picked up the slack is just manufacturing and petrochemicals, single-use plastics, medical plastics, personal protection equipment, all of that, on top of a winter seasonality for propane. So we've seen this other oils category, which includes naphtha and gas oil and refining and petrochemicals, as well as propane and propylene. That's normally 25 to 7% of U.S. petroleum demand, but in the last few months, it's been over 30%. So, really big jump up thanks to COVID-19 and thanks to more variants of COVID-19 that have coming that are keeping a need for these petrochemicals in place.
On the flight stuff, because I think we looked at that a week or two ago on the show, talking about the total number of flights and kind of seeing what you're reporting here. And I don't know what percentage of the passenger flights historically have been these long international flights, but as assuming the vaccine rollout continues to happen and international travel picks up, you could see an uptick in international passengers. And then all of a sudden you're going, okay, what do we need more flights? You're trying to figure all that out. And so the fact that the airline industry is only down 13% of flights, total flights, but down 56% of flights, could we find ourselves in a spot where we're like, oh wow, we're we're going to need more jet fuel because, the percentage of passengers getting back on planes wouldn't seem to be as much as needed as it would have a year ago because we've got more flights from different spots now, or different industries rather. Cargo flights.
It's a good point, and I mean, anecdotally, as people are getting vaccinated, I am seeing where more people will commit to vacations that they're planning. And if they can get a good deal on a flight and lock that in right now, they're planning forward for the summer or the fall to be able to do that. Internationally, it's still a challenge. If you are still looking forward to that vacation in Italy this summer, but they just re-locked down, that's going to be a problem. So it is going to change where people go and how far they go. But there's no question there's a pent-up demand for it.
Well, I think, talk about anecdotal. I haven't verified this, but I was looking to go to South Africa a few months from now, and I was just seeing. I used to fly from Atlanta to Johannesburg nonstop, and I don't think they actually offer that flight anymore. They at least I couldn't find it to book it. Now it could just be a COVID travel thing or something like that. I don't know, but I couldn't find it for the time period I was looking at. So but that's a long flight full of a lot of people. They used to have two going. I think they had one going and one coming at all times, and so in that pattern. So you think about those long flights that suck a lot of gas, and I know someone the other day on a call, someone he's been in China for a year, hadn't come home because of all the immigration stuff and all the customs and all the visa problems, and so all those people are kind of bottled up, and so when they're free to go, we could see and that's a lot of passengers on those flights. And so again, I don't know percentage wise what it makes up, but I'm just curious if we will find ourselves once the vaccine and then all the immigration and the visas and all that stuff is kind of worked out, if we'll see ourselves with a huge uptick in passengers. And then we have so I'll stop there. Ellen, what else you got?
Oh yeah, I was hoping we could talk a little bit about the monthly statistical report too, and some of the interesting things I thought were, I guess we touched on this on looking at gasoline demand month on month, but I was wondering if you could comment a little bit on how the Texas freeze or anything from that was impacting. What's kind of the ultimate? What?
Too soon to talk about that. It's a little,
too soon to talk about that.
A little sensitive still.
Yeah, I was just wondering if we could talk about maybe how it affected refinery runs or anything in the data that we should kind of take note of.
No, it's great to ask because it really did have a big impact, and we try not to dwell on it in the summary. So the demand numbers nationwide, there you get a pretty sound reading, but especially because of the regional concentration of production and refining activity and a lot of trade and port activity, all of those measures, imports, exports, refining activity, and production were affected. Now, the production chugged along to a certain extent. The ability of refineries to take it dropped at one point in mid-February to the lowest we've ever recorded, some 56% utilization. So we've never seen a lower data point for that. And it's like, wow, okay. It was higher for the monthly average, and it came back a bit toward the end. But even coming into early March, we've seen lingering effects of this on the refining side. So this is part of why explaining that we've had inventory builds, it's not necessarily a bad thing, right? I mean, the production is continuing, the demand is there for it, but the crude oil inventories swelled a bit because of just lack of uptake in the refining sector. But that should normalize. You'll get through, you'll get into summer driving season here before long, and some things should normalize in both the way we look at the data and frankly the way the market's actually functioning there. The trade side's interesting because this one, we've gone from being a net exporter to being a petroleum net importer, and we had celebrated in 2020 for the first time on an annual basis in literally 62 years that the U.S. was a petroleum net exporter, and we've reverted to that. And what is notable here is that we see it on the monthly basis coming in, and on top of that, EIA's expectation is that starting really in May this year, that we may be a petroleum net importer for the year on a pretty prolonged basis here. And this is just collateral damage of having less domestic production. It's been on a month-to-month basis, it's been right there. It's been a narrow difference between the two, but EIA's current outlook says that we'll be importing more, or relatively more than we are exporting.
So how long do you expect to see for the kind of normalization process to go out? Like, how long should we expect to see some of the lingering effects in the data?
I would hope after March, March should have some rebound effects that come into it, and then after that, it should be full steam ahead.
Okay, so we'll let you go kind of with this. I know we got stimulus checks coming out or are out or been out. Have you guys tracked how that's impacted demand usage of the past two iterations, and what might we expect? I know you don't make forward projections, but have you just looked at that and said, okay, when the stimulus were cut, we saw people increase driving and they increase flying. Anything that we might look forward to next month to look at as a result of this $1.9 trillion stimulus check?
We haven't really honestly tried to time the stimulus checks and align that up. I think it is worth noting that it's not just the check, it's what it means to the majority of American households of continuing activity, being able, if the thing that from a top-down economics perspective that we're really monitoring is this relationship between the economy and energy use, what makes that relationship remain intact is the fact that people didn't have their car repossessed. They still have a car and they can still drive. Hopefully they may even have a job still, or maybe a different job, but they have a job because there was some support that was on the margin provided by the stimulus efforts. So whether we're talking about repossessions, evictions, having a home and home energy and things that go with it, a lot of negative outcomes and follow-on impacts that were potential as a result of this recession have been mitigated as a result of both the direct stimulus checks, but also the broader efforts as part of the stimulus package.
Okay, Dr. Foreman, last question for you. Will you do your part to help gasoline demand by going on spring break this year?
I would love to. I am personally, truth in advertising, I'm waiting for a vaccine before I do any non-national park kind of travel. So my personal travel has been national parks.
Okay. Well, Dr. Foreman will not be doing his part to help gasoline demand. It's okay. Okay. Well, listen. I got 3 EVs out in the garage, so I can't say anything.
I actually have a windmill in my backyard.
I'm kidding.
No, I will add, I incidentally got an email from a friend in Saudi Arabia this morning, and Saudi Arabia is ahead of Montgomery County, Maryland, in terms of its rolling out of the COVID-19 vaccine. So those international flights may rebound sooner than we can get out of the county here in Maryland.
Well, I don't know where Saudi is getting theirs from, but I know China is dumping all kinds of vaccines into Africa all over the place. I think Egypt has picked 300,000 up from China on Saturday, and several. So I don't know where the Saudis are getting there from, but if you want the China vaccine, they're passing them out like hotcakes over in Africa. So what that's worth. So,
might be faster.
Yeah, Dr. Foreman, it's lovely to have you on.
Bonus. You can speak Chinese afterwards.
There you go. We will get you back on again next month and look forward to talking to you then. And maybe you'll be vaccinated and we'll be out and about doing your part to getting this demand back up. So we look forward to talking to you.
Absolutely. Yeah. Nice talking with you both. Thank you.
Thanks for coming.
And once again, that is Dr. Dean Foreman with the American Petroleum Institute. You can go to api.org and look at Chief Economist to find the reports. We'll try to link to them in the show notes as well. Miss Wald. It's that time. Oh, we got to talk about Tesla real quick. You got a few extra minutes?
Yeah. Okay. All right. What should we talk about Tesla?
Did you see the Chinese accuse them of spying, using the data to spy on the Chinese in their Tesla cars? Did you see that?
Using this to spy. I mean, we all know that they collect data.
And so the Chinese are like, you're spying on us. And so they banned
the US,
I guess. So they banned or temporarily banned or whatever the military and government officials from driving their Teslas.
Oh, I did see that. How many of the military and government officials did drive Teslas?
I don't know, but let's just here was kind of my thoughts. Okay. I know Tesla had the data. I never really thought about the implications of it, but we now China has now set the trap that Tesla will be hacked and the data will be released. Right? That's coming now, right?
Yeah, without a doubt.
So, and the other thing I thought about was, there was an article in, I think, Bloomberg talking about Tesla's EV problem in China, because there's cars that are, fundamentally cheaper in China. They're not as good, but they're, like $10,000 US. And so, people in rural China can afford those. But are all EVs tracking the data like Tesla?
I doubt it, but I doubt it, but I wouldn't be surprised if they were, but just
right.
Later.
Yeah. So anyways, I just find that interesting because I really, I don't know how Tesla gets out of the China thing unscathed. Like that just seems to be. I thought they were getting scathed before, and the Tesla bros keep running the stocks. I don't know, but this seems like that's a uphill battle for them. But
yeah, I don't think they want Tesla there.
Yeah, Ms. Wald, where will you be this week?
This week I will be on investing.com, and I will be on War Room newsletter. And that's probably about it. And I am not going to be here next Monday. Sad.
Are we doing the show Tuesday, or we don't know? We'll let you know on Twitter. We haven't decided.
We'll decide.
We'll decide. Let you know. So if we're back, it will be next Tuesday. If not, we will take a week off and come back for our it's our spring break episode if we take off. So just okay. Text One Guest podcast for newsletter. I'll be there as well. Miss Wald, it was lovely as always. Listeners, thank you so much. Talk to you next week.
Bye.
Week after, baby.
Yeah.